In the fast-paced world of consumer goods, even iconic brands like Gillette, under the umbrella of Procter Gamble, P&G, can face challenges. On February 23, 2017, P&G's chief financial officer, John Moeller, dropped a bombshell: a 12% price cut on Gillette razors and blades, set to kick in by April. This move aimed to counter the market share decline Gillette had experienced over the years, a situation reminiscent of the infamous Marlboro Friday, faced by Philip Morris in 1993. Bonnie Herzog, a seasoned analyst from Wells Fargo covering P&G, found herself at the center of the storm. Herzog had consistently given P&G a market perform rating since November 2016. Her concerns were rooted in the company's slowing sales growth and diminishing market shares, particularly in key categories like Gillette, where the shaving giant's U.S. market share had dwindled from 70% in 2010 to 54% in 2016. P&G's decision to slash prices mirrored Philip Morris's bold move decades earlier. Marlboro Friday had its short-term setbacks, but it ultimately helped Philip Morris recover lost ground. Faced with the rise of budget-friendly subscription services like Harry's and Dollar Shave Club, Gillette was following suit. The question on Herzog's mind is, was this price cut a canary in P&G's coal mine, signaling potential challenges for other brands? As Herzog delved into the intricacies of the price cut, her immediate task was to gauge its impact on Gillette's demand and profitability. The answers to these questions would unravel the story behind P&G's strategic maneuver, allowing Herzog to paint a clear picture of the economic implications for clients and shed light on the pivotal moment Gillette faced in reclaiming its market dominance. The shaving landscape: wet versus dry. Understanding the razor landscape is crucial to deciphering Gillette's bold move. Shaving can be categorized into wet and dry, with wet shaving involving traditional creams and water, and dry shaving involving electric razors. In 2013, a survey revealed that 59% of men preferred wet shaving, 36% opted for electric razors, and 5% embraced the au naturel approach. Historical razor evolution. Gillette, a key player since 1903, revolutionized razors with disposable blades in 1903. Fast forward to 2015, when razor cartridges dominated 53% of the wet shave market, outpacing disposable razors at 33%. A global wet shave market estimate projected $22 billion in sales for 2015, set to soar to $31 billion by 2020. Interestingly, even with the rise of shaving products for women, men continue to dominate the market, albeit shaving less frequently due to shifting societal norms. Gillette's success story began during World War I, when the U.S. government distributed Gillette shaving kits to soldiers. By the 1920s, millions of razors and blades were being sold globally. Over the decades, Gillette introduced new razors and blades, employing a strategy that urged customers to trade up the product ladder by offering diverse price points and enhanced features. By the 1970s, Gillette's razor and blade lineup was expansive, but the core products remained the most profitable. The company's CEO during the 1990s, Al Zion, emphasized the importance of constantly introducing new and improved products and maintaining a mindset of quality. Warren Buffett, after a $600 million investment in 1989, hailed Gillette as one of the world's best companies, attributing its success to a relentless focus on quality. P&G's acquisition and market challenges. P&G acquired Gillette in 2005 for a whopping $57 billion, a move praised as a dream deal by Warren Buffett. However, a few years later, Gillette faced challenges as competitors like Schick introduced compatible razor cartridges. Two new players, Dollar Shave Club and Harry's, entered the market, capturing 12% by late 2016. The dynamics had changed, and Gillette needed a strategic response. Enter Schick, historically trailing behind Gillette but adapting to the market. Following acquisitions and integration into Edgewell Personal Care in 2015, Schick's core products, the Quattro and the Hydro, faced competition. Edgewell, with a diverse product portfolio, has witnessed declining sales and profitability in its wet shave division over the past 3 years. The stage is set for Gillette's strategic gamble and its ripple effects on the razor wars. Dollar Shave Club, the game changer. Enter Dollar Shave Club, DSC, founded in 2011 by Michael Dubin and Mark Levine. At a time when razor subscriptions were struggling, DSC disrupted the market by offering subscriptions for 2, 4, and 6-blade cartridges priced from $3 to $9 per month. DSC's edgy YouTube ad in March 2012 catapulted them into the limelight. The response was overwhelming, with 12,000 sign-ups within 24 hours, crashing their website. Riding on this success, DSC secured $160 million in venture capital, expanded its razor selection, and claimed 8% of the market by 2016. Chris Ferrara, an analyst at Wells Fargo, highlighted the impact of DSC's irreverent brand attitude, stating that the online shave category was as much about attitude as it was about convenience. Unilever's billion-dollar bet on DSC. In 2016, Unilever made a bold move by acquiring Dollar Shave Club for $1 billion. Kees Kruithof, Unilever's North America president, emphasized leveraging Unilever's global strength to support DSC's growth. This marked a trend where major consumer packaged goods, CPG, firms opted to acquire innovation rather than develop it internally. Harry's, a cut above the rest. March 2013 witnessed the launch of another contender, Harry's, by Andy Katz-Mayfield and Jeff Rader. With a minimalist, vintage, aesthetic and, quality, German blades, Harry's offered razor handles, such as the plastic, Truman, for $10 and the aluminum, Winston, for $25. Subscriptions delivered replacement razor cartridges every 2 to 6 months for around $2 per cartridge. Within 2 weeks, Harry's sold out its entire inventory, prompting a strategic move, acquiring the factory that produced its blades for $100 million. This move allowed Harry's to control its supply chain, enabling faster development and shipping of new razors compared to competitors like DSC and Gillette. In a surprising shift, Harry's entered Target stores in 2016, pricing its products similarly to online subscriptions. Placing its products next to Gillette's on Target shelves, Harry's aimed to reach over 90% of its customers who also shopped at Target. Jeff Rader emphasized the brand's commitment to differentiation, promising a premium, accessible, and frustration-free purchasing experience. The razor wars were intensifying as Dollar Shave Club and Harry's brought their unique strategies to the battleground. The Procter Gamble Company, a giant in transition. Procter Gamble, P&G, the consumer goods behemoth, stood at the forefront with net sales of $65 billion in 2016. With 65 major brands, including Gillette, it reigned as the world's largest consumer goods company. Despite this, challenges loomed, and the grooming division, led by Gillette, faced scrutiny. In 2016, it generated 15% of P&G's net earnings while accounting for 10% of sales. P&G's CEO, David Taylor, initiated a major restructuring program to cut costs, aiming to slash $10 billion within 5 years. However, as sales dwindled, challenges mounted for P&G. Gillette's struggle and the activist investor. In 2013, P&G reported a 3.6% decline in revenue in its grooming division, primarily attributed to a reduced incidence of shaving. Despite efforts to introduce new razors like the ProGlide, FlexBall and a subscription service, sales continued to plummet. In 2017, activist investor Nelson Peltz, known for pushing for significant changes in consumer goods companies, disclosed a $3.5 billion stake in P&G. In a bid to regain market share, Gillette took a bold step in February 2017. During a presentation at the Consumer Analyst Group of New York, CAGNY 2017 conference, CFO John Moeller announced a 12% average price cut on men's shaving products starting in April. The move aimed to invest more in marketing and expand lower-priced product lines, a shift from their historical focus on premium products. Moeller stated, "We are making smart adjustments across the lineup to restore a historical model and proven strategy." Analyst reactions. Defending market share. Analysts speculated on the motives behind the price cut. Some saw it as a defensive move against competitors like Wells Schick, while others believed it sent a message to potential acquirers like Unilever. The move indicated a departure from P&G's earlier strategy of focusing on super premium innovation. Analysts at Barclays noted that P&G seemed to be finally listening to consumers' changing preferences and the rise of disruptive brands. Consumer shift. More than just price. The razor landscape was evolving, with consumers seeking emotional connections and fair treatment rather than just low prices. Analysts and industry insiders emphasized the changing dynamics, citing the rise of disruptors like Dollar Shave Club and Harry's. Consumers were drawn to brands that reflected their values, signaling a shift beyond a mere price point conversation. As Gillette took a bold step with its price cut, the razor industry stood at a crossroads, navigating a terrain where consumer sentiment and brand affinity played pivotal roles. Cracking the financial code, Herzog's quest. As the news of Gillette's price cut reverberated through the industry, the financial world turned to Bonnie Herzog, a seasoned analyst at Wells Fargo, to estimate the potential impact. Armed with financial acumen and market insights, Herzog embarked on a complex journey to unravel the financial puzzle. The data dilemma. Estimating the impact. Herzog faced a formidable challenge due to the lack of specific data from P&G on Gillette's unit sales, pricing, and cost structure. To gauge the repercussions of the price cuts, she needed to make informed assumptions about Gillette's internal workings. The elusive price elasticity of demand, a crucial metric, added another layer of complexity. Preliminary estimates hinted at a demand elasticity of 0.80, but Herzog acknowledged the wide margin of error, ranging from 0.50 to 1.10. Navigating unknowns, assessing accuracy. In the absence of concrete data, Herzog had to navigate uncertainty. She grappled with questions about competitors' responses, potential shifts in retail prices, and the overall market dynamics. The short-term nature of the available data further complicated matters, as the price cuts signaled a permanent shift in Gillette's pricing strategy. Elasticities and beyond, multifaceted challenges. The intricacies multiplied as Herzog considered varied elasticities across products, distribution channels, and geographic locations. The relationship between razors and blades, the durability factor, and the potential impact on consumer behavior posed intricate challenges. Industry experts hinted at a shift from inelastic to elastic demand, emphasizing the altered landscape for manufacturers like Procter Gamble. Race against time. Herzog's quick assessment. With clients eagerly awaiting her perspective, Herzog raced against time. Amidst concerns about the accuracy of her estimates, she needed to provide insights swiftly. Would the projected impact be substantial enough to warrant a shift in her current market performance recommendation? Beyond the financial implications, Herzog had to unravel the strategic significance of Gillette's move and assess its potential domino effect on other P&G brands. In the financial realm's intricate dance, Herzog's analysis held the key to decoding Gillette's strategic gambit. As the industry waited with bated breath, Herzog's assessment would shape the narrative of P&G's financial trajectory in the wake of a game-changing decision.